So, welcome to today's presentation. My name is Peter Youssef. I'm a senior market analyst at IronFX. In front of your screens, you have your USD's daily chart. We are going to be mixing technicals with fundamentals. I would make a start with the US dollar. And okay, we have a low number of high impact financial releases from the US today, not only today, in the week. And overall, we see the case for fundamentals to be the main factor behind USD's direction. Now, fundamentals, in my opinion, for the US dollar could be broken primarily in two issues. The first would be the Fed stance. We all know that Fed Chairman Powell over the past week had stated that the bank is in no hurry to cut rates. On the one hand, okay, it didn't say that they will be suspending the rate cutting program or the easing of the monetary policy. But on the flip side, I would be surprised to see the bank maintaining a slow, steady rate cutting pace over the coming months. Um, the stance as such may be providing some support for the USD. I would expect the Fed to keep a cautionary stance also given what President-elect Donald Trump has stated in the past, the pre-election period, about what measures he would be taking for not only the US economy, but the US in general. And they tend to be more on the inflationary side. For example, the idea that he's going to be rounding up illegal immigrants and general immigrants could have inflationary pressures as that could create a scarcity in the working force and practically allow for wages to rise at a faster pace. I wouldn't be surprised also to see the Fed pausing at some point its rate cutting path. But for the time being, I think that the December rate cut is really priced in. There are no major questions about it right now. The second issue would be Donald Trump himself. Now, Trump as a character tends to be unpredictable, and uh, that's definitely not best for the market. Say, for example, should he make a tweet or some statement, he could easily create mayhem in the markets, and that could go either direction. However, that uncertainty may provide some support for the USD as the main choice safe haven influence. Now, on the euro side of the pair, things are even worse. There is no major factor behind the possible rise of the euro fundamental level. It's characteristic that growth in economic activity indicators tend to be on the low side and actually quite worrying. There was some acceleration of inflation, however, that's expected by the ECB. So nothing much has changed there. It's not something which could take the market by surprise and provide some support for the euro at the time being. Um, on a more fundamental level, I would note that the ECB is inclined to continuing cutting rates. Now, there was a rejection of the idea of a double rate cut, but the idea of further easing its monetary policy seems to be sustainable, and that could be another factor weighing on the euro. And last but not least would be the political scene, especially in Germany, where practically we have elections at the end of February. Do not expect to see a new German government being quickly formed. Most probably could take about a month So the German government may be unable to act on a government basis, on a political basis, from now on up until the mid, maybe even end of April. So being inactive definitely does not help the euro here. And please note that the inactivity extends beyond Germany, also on a European level. Uh, on a technical level, euro USD seems to be maintaining sideways motion, and the boundaries seem to be verified between the S1 1.0490 and the R1 1.06. We maintain this outlook, but note how the RSI indicator is quite low. It's actually at 35.6, which tends to imply, in my opinion, a bearish predisposition on behalf of market participants for the pair. And should that be realized, I wouldn't be surprised to see the pair breaking the S1 1.0490 and start aiming for the 1.0, sorry, 0360. Such a scenario would practically allow us to shift the downward trend which has been broken to the right and renew the bearish tendencies, showing us the limitations of the possible downward move. Bullish outlook would be the third option. It's the least favorable for the time being. However, it's possible. And for the adoption of the bullish outlook, we would require the pair to rise, reach the 1.06 resistance line, and actively aim, if not reach, the 1.0755 resistance level. Moving now to JPY. Now, JPY rose in today's Asian and European session. You can see that as it's expanding right now. On a fundamental basis, we have covered the USD, that's clear. Let's readjust the chart a bit, correct the position of the labels, make the whole picture a little bit more visible here. On the JPY side of the pair on fundamental basis, I would be highlighting the adjacent tensions. And we may be seeing JPY a bit worried about weakening of JPY. It's characteristic that in the past, if I'm correct, Japanese officials warned about a possible market intervention to JPY support. Actually, they warned against speculative moves of selling JPY. Um, on a monetary level, I would be also highlighting BOJ's intentions to hike rates in the coming week. And that may be one of the main determinants of JPY's movement direction. Should the BOJ governor, whether practically in his next scheduled comments, those should be tomorrow during the late Asian session, should he more or less verify the bank's orientation towards normalizing its monetary policy, i.e., hiking, then we may see JPY getting some support. On a technical level, USD JPY's upward movement, in my opinion, remains clear. We had we have the upward trend line which has been separated since the last days of September, for the 30th. Yep, that's still being maintained and it's still clear. Uh, I would expect the upward motion to be maintained as long as the upward trend line remains intact. Also, there are indicators above the region of 50. It's at 63.04, more or less implying once again a bullish predisposition on behalf of the market for the pair. I have one hesitation Despite maintaining the bullish outlook, I would feel safer for the upward direction of USDJPY if it forms a higher peak than this one. And you can see how the past price action has formed 1, 2, 3, 4, 5, 6 continuous higher peaks and a similar figure of higher truths. Now the higher truths seem to be confirmed, but I would need more confirmation by seeing the price action nearing 158.35, definitely a bit higher, peaking a bit higher than this one. Should the bulls remain in control, we set as the next possible target the R1 158.35, and should the R1 be broken, the next possible target for the bulls would be the R2 162. Mind you, that's more than a 30-year high. And in my opinion, the pair has entered relatively dangerously high levels, signaling an extended weakness of JPY and at the same time strengthening of the US dollar. On the flip side, should the bear stick over, we would require the pair to drop, breach definitely the upward trend line in a signal that the upward movement has been interrupted and reach as low as the S2 151.30. While a sideways motion could also emerge should the price action rotate around the 154.80 S1 level. Moving on to GBP/USD. Now that's interesting. And what's interesting about the cable is today's downward motion. The UK CPI rate for October were released in today's early European session. The rates showed an acceleration of inflation both on a headline and a core level, and the pound got some support at the time of the release. Allow me to drill into the 1 minute chart and let's have a look at the movement as such. Here you go. Practically cable jumped at the time of the release, allowing for a positive gap to emerge. You can see it right here. And it was of 20 pips if I'm correct. Yeah, 21. That was impressive at the time of the release. And I would be stating also that the acceleration of UK CPI rates may alter the bank's stand regarding its monetary policy. For the time being, the bank is widely expected to remain on hold in the December meeting, and actually, such CPI rates could enhance such expectations. But the pound quickly corrected lower and even corrected below the 126.75 resistance line, a level which was tested during today's early European session. We tend to maintain a bias for the sideways motion to continue. On the other hand, though, the bears may have it, in my opinion. And what we see practically over the past 2 weeks, Monday and Tuesday, the slight rise may just be a correction lower on the technical level, given that price action had dropped below the low bulge band. Um, the idea of the bearish outlook being renewed is also supported by the RSI indicator, which remains very close to the beginning of 30. It's currently at 65, 67, 30, 34, sorry. And in such a case, should the bears have it, I wouldn't be surprised see the price action of cable approaching, not breaching the S1, 1.2515. Yeah, that's about it. For the time being, you would expect a sideways motion to emerge, with the price action remaining rotating around or being just below the 1.2675 resistance line. A bullish up is pretty high. The price action for the adoption of a bullish outlook, the price action would have to breach clearly the 1.2675, breach also the blue 1.845, and aim, or if you prefer, reach the R3 1.3040, nothing less. And I'm saying this because I would require for bullish outlook to be adopted a clear breach of the downward trend line, which has been guiding cable since, let's have a look, the 27th of September. Now, on a fundamental level, UK's government, despite being definitely more solid than what the conservatives had presented in the past, it's still like a puzzle in the following sense. On the one hand, the the UK government and especially UK's Chancellor of the Exchequers, it's the correct title, Rachel Reeves, seems to be determined to actually cut the bureaucracy, the red tape, especially for the UK financial sector. It's a crucial sector for the UK economy. And actually, if that's the case, we may see some improvement in the GDP rates, which would be supportive for the pound. On the flip side, you see a Labour government which is practically cutting pension. And that's discouraging and could weigh up. Okay, let's have a look at USD CAD. USD CAD, which is correcting higher after the white drop. Let's reposition the labels. Now, on a technical level, the price action confirmed two things. The first would be the validity of 1.3945 as one as a support line. Note how the price action was falling on Monday and Tuesday and seems to be bouncing higher just above the S1. At this point, I would be also noting that as also for the time being at least verified the validity of the upper trend line, which has been guiding USD CAD since the, let's have a look, since the 25th of September. So for the time being, we tend to maintain our bullish outlook. We note that the RSI indicator is at relatively high levels. It's not that fancy 60 plus, it's at 58. So there is a slight bullish tendency left in the market for the pair, which could drive it higher. Once again, though, for the bullish outlook to be confirmed, we would require the pair to rise and reach the R1 1.4088. As practically for the bullish outlook to be maintained, we would require higher peak than this one. So the R1 has to be broken for the bullish outlook to be maintained. And the next possible target for the bulls would be set at 1.42. Mind you that we are talking about, if I'm correct, an all-time high. No, it's not. The R1 is a level which has not seen any price action since May 2020. So this is a 4-year high, 4 plus. And we require for bullish outlook to be maintained the R1 breached. Okay, let's have a look at the Aussie. Okay, the Aussie's movement allows us to set the support line lower and being green at 0.6445. Let's reposition the levels as well. Starting with the R3, which has now been set at 0.6820. The R2 at 0.6705. The R1 at 0.6555. S1 at 0.6445. The S2 at 0.6036. And this one at 0.6027. Locking everything in. Is the bearish outlook being maintained? It seems to be so. The arrow indicators at 41 could be a little bit lower, but it seems that the pair is forming a lower peak. Yet for the bearish outlook to be maintained, we would require the pair over the next couple of days to breach the S1 0.6445 and thus start aiming for the S2 at 0.6360. Otherwise, should the downward trend line guiding the pair lower be broken, that would imply a sideways motion, yet for the sideways motion bias, we would require the pair to remain between the R1 0.6555 and the S1 0.6445. Should the bulls take over, definitely the downward trend line is going to be broken, as we expect also the R1 to be broken, and the price action to start actively aiming for the R2 0.6705. Let's have a look at WTI. WTI, which seems to be remaining in a sideways motion between the 64.60 and the 72.10. Okay, there was a small rise on Monday, but nothing which tends to allow for speculation and a change of trend. For a bullish outlook, we would require the price action to rise to reach the 172.10, which is the upper boundary of the current sideways motion. It's interesting how the price action of the commodity has tested it, and yeah, over here, but also here, here, to the downside, here, and next possible target for the bulls beyond the obstacle of the R1 is the R2 at 77.85, which was marked by a beautiful peak right here. On the flip side, should the bears take over, we would require for bearish outlook the price action of WTI to breach the S1 64.60, a level marked by this true here, and start aiming actively for the S2 57.15. Let's also have a look at gold's price. Let's readjust the levels. And definitely we have to make corrections here. Starting with the R3, which is set at 2,790. The R2 at 2,685. the one at 2,600, the S1 at 2,470. However, the price action of gold over the past 1 week, I think, has created new support line. And it's characteristic how the price action's downward motion was holded right here. That's the 2,535 support level in green. And that forces us to practically recalibrate the support lines of gold's price, narrowing them down. Another support line could be brought here. 1, 2, 3, 4 touches. That's good. And another one. I would be setting it here. So practically we have 2,470 still standing. That's nice. And the S3, which must be at 2,390. Yet the price action of the precious metal has risen and has breached at 2,600. We're switching this into support line and form the new resistance level at 2,900 in red. Correcting the label, setting 2,800. Now, gold's price on a fundamental level uh, has rejuvenated its negative correlation with the US dollar and US bond yields. So that's, in my opinion, the primary factor behind the direction of the precious metal. I would be noting here also the high uncertainty at geopolitical issues. To tell you the truth, I'm quite worried about the situation in Ukraine, given that the Americans gave a green light to the Ukrainians to actually hit Russia with long range missiles. Now, long range, it's a figure of speech. Attacks have, if I'm correct, 300 kilometers range, but it's the gesture which counts at this point, in the sense that it's characteristic how the Russians felt a little bit threatened and actually lifted the nuclear doctrine. So practically they lowered the standards to use nuclear weapons. And the Ukrainians did actually use already US long range missiles to hit Russia. So the issue there is quite tense, and we view it as further escalation on a qualitative level of the war in Ukraine, which could prompt a Russian response further. Now, there was lots of discussion about Trump possibly ending the war. However, Trump has still 2 months to come into office. Hence, up until then, we may see the Biden government trying to provide Ukraine with a better bargaining position. However, that remains to be seen. If that's the case, expect substantial escalation, which could create substantial uncertainty in the market and thus create safe haven inflows for the precious metal, and I'm talking about gold here. For the time being, we tend to maintain a bias for the sideways motion to be maintained. We understand that it has breached above the S1 2600. On the other hand, though, I would be noting how the downward trend line aligns with the correction lower during today's Asian and European session. If that's the case, then for a bearish outlook, we would require a lower trend than this one. So for a bearish outlook, the price action of gold has to drop, breach the S1 2600, but also breach the S2 2535, with the next possible target for the bears being set at S3 2470. On the flip side, should the bulls find renewed control over the precious metals price action and direction, I would require for the bullish outlook to be adopted a breaking of the R1 2685 that will provide resistance back here. While even higher, we note the 2790 resistance line, which is practically a record high level. That should sum it up from all of us here at IronFX. We hope that you found this report useful. And from all of us here, best wishes for solid trading.
Okay, let's go ahead and get started. So this week's webinar will be on multi-time frame trading strategies. And before we get started, just a risk warning as per usual. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie Chong, and I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. So we're going to look at which time frame is the most important, how you can take a top-down approach, what you should look out for on the higher time frames, zooming into lower time frames, and then we'll look at how you can craft your strategy. Okay. Okay, let's get started. So firstly, before we get into everything, we're just going to do a really quick recap on the basics of trading. Okay, so firstly, we'll look at support and resistance. So it's basically the price at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So to identify these levels, you can use technical analysis tools such as trend lines, moving averages, chart patterns, or you can also look at previous highs and lows of the asset, as well as volume data to identify potential levels of support and resistance. So we're gonna briefly look at this today, and then we'll get into I'll show you guys in a little bit why we're going through this before we get into the multiple time frames. Yeah, so it'll make more sense in the next slides. Okay, so I've added an image here for you to see how we can use swing highs and lows as resistance and support levels. So you want to take note of how there are clear peaks and troughs in the market structure, in order for them to be used as support and resistance levels. So let's first take a look at an incorrect example. So here's an example of insignificant swings, which are bad points to use for any kind of levels. So be it your support and resistance levels or starting points for your Fibonacci. Price movements over here are way too small and there are no significant swing highs or swing lows. Okay, so here's another incorrect example. So there aren't really any clear swing highs or lows and price movement is relatively small. Okay, so now here's a correct example of significant swings. So there's a really clear move up and down with obvious peaks and troughs and clear market movements. Here's another example. So I've drawn out the peaks and troughs to point out exactly how clear your charts should look like. Okay, so you can take these support and resistance levels as profit targets or stop loss levels, but you should not use it as an entry if there are no other supporting arguments such as Fibonacci or other graphical levels to support your analysis. Okay, because using a recent swing high or low is a weak level if that is the only level. Okay, so if there are at least two swing highs or low levels lining up nicely, then it's a much better level to use. So you want to try to find areas where these might line up. So it doesn't have to be exactly at the same level. So long as it's about a similar area, that's good enough. Okay, so one way to try and find these multiple swings is to try and see how far you can pull back your resistance or support levels. Okay, so as you can see in the GIF, it's okay to cut through these tiny wicks, but you typically would want to avoid cutting through the bodies of candlesticks. Okay, so now let's look at um, what other things to look out for when inputting a support or resistance level. Okay, so picking the starting point, you want to look for, or rather a pivot entry. You want to look for support or resistance levels, and there are a couple of rules. So firstly, you want to check if there's a swing high or low, pullback or overlap level to start from. Okay, so I mentioned earlier that we want to try and pull back the level as far as we can. Intersecting the wicks is preferred. You can refer to this image here. So you can see this green thumb is obviously that it's recommended, which means basically because it cuts through only the wicks of the candlesticks. These are okay because even though it does cut through only the wicks, it's not that preferred because there isn't a very clear swing high or swing low over here. Okay, so preferably we want to look for intersections that we will see in the coming slides. So for example, here we have a red thumb here, and the reason for that is because it cuts through way too many bodies of the candlesticks. So you can see the green thumbs here cuts through just the wick of the candlestick, which is preferred. Okay, so just basically I want to look for a nice clean cut and not something that's messy like this one here. Okay, so another example here. Take note of this red highlighted area because you want to avoid intersecting so many candlesticks. Even though you might be able to argue that over here it's just the bodies, or rather it's just the wicks of the candlesticks, but it's way too messy over here. Okay. Okay. Next. So here's what a clear market structure looks like. Um, Fibonacci retracements can be used in both choppy and trending markets, but it is important to look for a really clear market structure even before you get started on your actual analysis. Okay, so like for example here, this is an example of an unclear market structure. So you can see it's very messy, it's really difficult to conduct your analysis on. So this is typically something that you want to avoid. Okay. So which time frame is the most important? So one important thing that we can do to our analysis to adjust the time frames so that the market structure is clearer. So here we have an example of an unclear market structure. Okay, so this is on the 15-minute time frame, and you can see it's really messy. There's no clear movements in price. But if you change the time frame that we're looking at to 1 hour, this is what we have, and you can see the highlighted portion has much clearer movement. So it's way easier to conduct your analysis on the H1 instead of the M15. And both of these is on the same asset that we are analyzing. Okay, so there's two criterion that you should look out for. Firstly, a clear swing low or swing high. And secondly, a really clear trend as well between the starting and the ending point. Then your Fibonacci retracement or your analysis is more likely to be accurate. Okay, okay, so now let's look into um, a brief intro into our multi-time frame analysis. So now we've gone through what you should look out for and how you can kind of adjust your time frames so that your charts appear clearer. So let's look at what other things you can use with your multi-time frame analysis. So it basically involves analyzing the market from multiple time frames, and it can help a beginner trader get a better understanding of the market and make more informed trading decisions. So the first step in this strategy is to select the time frame. Typically, traders will tend to choose at least two time frames. So that would probably be a shorter time frame and a longer time frame. The shorter time frame is used to identify the most recent trends and price movements, while the longer time frame is used to identify the overall trend and market direction. So once the time frames are selected, the trader will then analyze the market from each time frame, looking for key support and resistance levels, trends, and patterns like we've done earlier. So for example, if the short-term trend is bullish and the longer term trend is also bullish, then it could indicate a strong uptrend in the market. So obviously, if you're a trader, this would be really helpful to make your trading decisions. So for example, um, if the short-term trend is bullish, then you might look into buying on dips or pullbacks in the market. Conversely, if the longer-term trend is bearish, then you might look to sell or short the market. Okay, so it basically helps you to kind of zoom out and look at the bigger picture, analyzing trends and patterns from multiple time frames. Okay, so what should you look out for on the higher time frames? Firstly, we have the key graphical levels. So basically the horizontal levels that we looked at previously, how to identify your support and resistance levels, which is why we went through them before we started this. And then, of course, being able to identify your trends using trend lines and trend channels. Thirdly, would be breakouts. So, breakouts of these trend lines or trend channels or any of the support and resistance levels. Big moving averages 50, 100, 200, golden cross or death cross. Ichimoku cloud also helps you to identify changes in trend or continuations in trend as well. And big Fibonacci levels that we mentioned earlier, such as your retracements, your extensions, projections, so on and so forth. And lastly would be price action. So price action basically is the past, present, and future. And you're trying to look at your momentum from the previous bar to dictate your strategy. Okay, so these are the different types of trading on the higher time frames. So for trend trading, it involves identifying and trading with the prevailing market trends. So traders would tend to enter positions in the direction of the dominant trend and hold them until the trend shows signs of reversal. This strategy often involves the use of technical analysis tools to identify and confirm trends. Next is swing trading. So, swing trading refers to capturing shorter term price swings within a larger trend. Traders tend to enter positions at swing highs or lows and take profits as the price moves in their favor. So, for swing trading, this strategy typically will involve holding your position for several days to several weeks, because you are trying to take advantage of the price oscillations. Okay, and then thirdly, breakout trading. So this involves entering positions when the um, price breaks through key support and resistance levels. So as a trader, you would tend to look for strong momentum and volatility following a breakout and aim to profit from continued price movement in the breakout direction. So this for breakout trading, it involves a little bit more careful analysis and of price patterns and the volumes to confirm your breakouts. Okay, lastly, we have mean reversion trading. So this is based on the idea that prices tend to revert to their average or equilibrium levels after deviating from them. So traders would identify overbought or oversold conditions and take positions with the expectations that prices will eventually revert. So this would typically involve you using a couple of technical indicators, so like your RSI, your stochastics, in order to identify these potential reversals. Okay, so if we look at the lower time frames, there are also different kinds of trading methods. So firstly, we have scalping. So this is a high frequency trading strategy where traders aim to make quick profits from small price changes. So they open and close multiple positions within a short period. And sometimes it could even be as little as seconds or minutes, um, as long as they catch small price differentials. So scalpers often rely on technical analysis indicators such as your moving averages or oscillators to identify short-term trading opportunities. For day trading, it involves opening and closing positions within the same day without holding positions overnight. So day traders would focus on intraday price movements, and they typically make multiple trades during the day. So they aim to take advantage of more short-term trends or volatility using technical analysis tools, chart patterns, real-time market data for trading decision making. Third, we have momentum trading. So this focuses more on capturing strong price movements that's driven by increased buying or selling pressure. So in order to do this, traders normally will look for stocks or assets that exhibit significant price momentum and then enter positions in the direction of the prevailing trend. So the kinds of tools or indicators that you would use would be something like your RSI or moving average convergence divergence or MACD to identify momentum opportunities. And lastly, we have news trading. So news trading involves taking advantage of significant market moves that result from news events or economic data releases. So traders will closely monitor the news, announcements, and enter positions based on the impact of the news on the market. So they aim to capitalize on the price volatility and rapid market reactions that occur immediately following news releases. Okay, so now that we know the different kinds of long-term and short-term trading, and we also know how to identify significant swings and use them as support and resistance levels, let's take a look at how you can craft your strategy, depending on, your lifestyle and what are the different kinds of time frames that you might choose. So starting off with scalping, this is obviously for a shorter time frame. So this kind of trading is fast-paced, it's exciting and mind-rattling. And there's obviously short time periods between the opening and closing of a trade, but you grab very small amounts of pips. You're also risking a very small amount of pips as well. So it does depend on your own um, your risk tolerance. But it allows you to take advantage of market volatility and you're able to avoid known unknowns. So your locus of control, because you're looking at 20 pips versus a 200 pips. And there are new opportunities every time you open the chart. Okay, so the holding time tends to be from a few seconds to a few hours. If you are trading, what we typically recommend will be 1 hour in the morning, 1 hour in the afternoon, and 1 hour in the evening. But it is important to have proper risk management so that you don't need to monitor the trades all the way. Okay. Now let's look at the three powerful scalping strategies. Firstly, we have the horizontal pullback strategy. Then we have the Fibonacci retracement strategy. And lastly, the Nike tick strategy. So firstly, horizontal pullback. Um, Basically, this is what we call pullback. So when price, um, so you can see firstly there is this resistance. It's a swing high resistance with 3 swing highs. So you can see that price has broken out of this resistance level. It's surpassed it, but we're expecting it to pull back or retrace back to this level. That's why we call it a horizontal pullback strategy. So this is what we call a pullback support because we are expecting price to bounce off of this level. A pullback resistance is something like this. So you start off with a swing low support level, and then price breaks out of that support level, and we're expecting it to retrace back to that level. Okay, so if we're looking at an example on the charts, here we have an example with Ichimoku. So the Ichimoku cloud, how you typically would use it is if price is moving below the cloud, then it's an indicator that price is in a bearish momentum. But if price is moving above the cloud, then it is in a bullish momentum. So in this case, we have this swing low here, and price bounced off of it. It has broken out of it, surpassed it, and now we're expecting it to come back to that level. Okay, and you can see that's exactly what happened here. Okay, so now if we're looking at a Fibonacci retracement strategy, you should remember that your Fibonacci trend line must follow price structure clearly. Even though the trend line can deviate from price structure, it shouldn't deviate too much. So in the example that you see here in this GIF, you can see that the line that's been drawn, this orange line, it is basically the shape of price structure, but our Fibonacci trend line cuts through the entire shape. So this is something that we want to avoid. Okay, so if you're new to Fibonacci, and I have a couple of questions on that in the chat, I'll just show you guys this website that you can use. I think we've previously gone through the Fibonacci series on these webinars, but if you've missed that, not to worry, you can go ahead and look it up on theforexarmy.com. Okay, so yeah, that's theforexarmy.com, and then you can take a look at this trading guide, which is pretty comprehensive. It gives you a bunch of examples, some videos as well that you can watch. Yeah, so it's everything that we went through today, and it gives you a more in-depth understanding of how to use the different Fibonacci techniques. So like your retracements, how to draw them, what to look out for, how to find confluence areas as well. Yeah, so you can go ahead and take a look at that. If there's time at the end of my slides, I might briefly go through some of these techniques. Okay, but if not, yeah, you can just take a look at this website. Okay, let's get back to my slides. So the tool that we're using here is the Fibonacci retracement tool. And there are a couple of levels that we're looking out for. So here you can see we're looking out for the mid-range. So 23.6, 38.2, 50%, 61.8, and 78.6. Okay, but even though the tool is the Fibonacci retracement tool, it leads us to 3 different types of Fibonacci expansions. Okay, so firstly, we have a Fibonacci retracement plus pullback. So this is the pullback that we just talked about. You have 2 swing lows here, price has broken out of it, and we're expecting it to pull back to this level here. Okay, we also have this retracement. So take note of how closely this trend line follows the shape of the price structure. And over here, you can see our 61.8 lines up nicely with that pullback level. Okay, I also have another Fibonacci level This is also a Fibonacci retracement. So it's from the upper swing high all the way to the lower swing high here, or swing low. Okay, so in this case, the 50% lines up nicely with that level. So we have two Fibonacci levels lining up with a pullback resistance. So we're expecting it to reverse off of this area here, which you can see is exactly what happened. Okay, if you're wondering why we chose this level as our I guess as our support, is because it's an overlap level, which basically means there is a swing high here and a couple of swing lows that line up in the same level. Okay, so that's why we are expecting price to be attracted to such areas. Okay, let me know in the chat if you guys have any questions as well. Next, let's look at this example, which is another Fibonacci retracement plus pullback, but this time we are also adding in a Ichimoku cloud. Okay, so here we have a descending trend line, but it's not exactly a valid trend line because it doesn't have we need at least 3 touches on the trend line to be considered valid. You can see over here we don't have that. Okay, so we're expecting price to bounce off of that level, off of the trend line again. We also have this Fibonacci retracement from the swing high to the swing low, and our 38.2 lines up at the area where we're expecting price to bounce off of. Okay, in this case, we are also using 2 indicators. Yeah, okay, let's look at this one first. The first indicator we're using is an Ichimoku. So you can see price is just about moving above the Ichimoku cloud, which is a bullish signal. Now, if we look at this slide, you can see our stochastic is giving us this hidden resistance level, which basically means that we're expecting price to also respect that area, like it did here. So you see we have one resistance level lining up with another over here. Even though price is making a lower high on our stochastic, it's remaining at this resistance level. So this is the second time that it's happened, and we're expecting it to happen again another time here, which you can see that's exactly what happened. Okay. Okay, so let's move on to our last strategy. So this is what we call a Nike tick strategy. So just to recap again, we have so many levels for 1, 2. Again, the tool we're using here is the Fibonacci retracement. So the Fibonacci retracement, we have the levels that are above 100, the mid-range levels, and the negatives. So the negatives we call Fibonacci expansions, but now for Nike tick strategy, we're going to look at the extensions. So for extensions are the levels that we use that are more than 100%. So that would be 127.2 and also 161.8. So here's an example. You can see the yellow arrows show us the shape of the Nike tick. So our starting point is over here, basically the head of the arrow or the shorter part of the tick. So you should make sure that price fully breaks out of this 100% before you go in and use this strategy. So our 161.8 is the projected level at which we are expecting price to reverse off of. Okay, you can see that's what happened here. That's basically what we are looking for. Any reversals off of either the 127.2 or like we see here, 161.8. Okay, so here is a GIF of what we are looking for and how it works. So we firstly want to see if it's going to break out of the 127.2 level. And if it doesn't, then we go in and expect there to be a reversal at the 161.8 instead. Okay. Okay. Um, let's move on. So for the Nike tick strategy, we typically would recommend these timeframes. So the M30, H1, H4. Entry criteria would be if price breaks out of the 127.2. Okay, so we're using a stop loss at 145%, idea invalidation at 138%, break even would be 11% of the recent move, 50% take profit will be 11% of the recent move, and a full take profit is 22% of the recent move. Okay, so you can see the levels that we are using here. Um, the bonus we are also using all of these levels. So let me get into them now. So firstly, let's focus on the Nike tick. I think you guys can kind of get the idea now. You can see the shape of the tick. So we're looking at the 127.2%, which price has reversed off of. For the Fibonacci projection, we are looking at this level here. This shape rather, this flash kind of shape. And it's also 3 points. 3 points would be the starting point, middle point, and ending point. And you can see that we have a 100% lining up at that level. Okay, so the 100% lines up nicely with our 127.2. Okay, and that is our kind of our Fibonacci confluence area. So since we have two levels lining up, we call that a confluence area because it's more validation that price is likely to reverse off of that area. Next, Fibonacci expansion. Okay, no, we don't have that here. But why we mention support and resistance is because at this swing high, if you draw a horizontal line across, we're actually expecting price to bounce off and hit back to that level, which is why we have highlighted this arrow to hit back towards this area. Okay, so here's a long example instead. Again, you can see the shape of the Nike tick. In this case, it's an upside down tick, or rather an inverted Nike tick. So the head is from here, starting point here, ending point here, and the tail is here. So we're expecting price to bounce off here, and it did. So it bounced off this confluence area. Again, the confluence area is the 127.2 Fibonacci extension or Nike tick. And then we also have this 61.8% Fibonacci projection. So for the projection, just to recap again, the starting point here, middle point here, and ending point here. Okay, so it lines up and we can see price shot up after that. Okay, so another thing to maybe take note of is this minus is what we call our Fibonacci expansions. So for Fibonacci expansions, we're looking at these two numbers, the minus 27.2 and the minus 61.8. So you can use these levels as well to determine where we expect price to bounce off of next. After this, after this reversal, you can see that there is this flash shape or lightning bolt shape. So it's very similar to your projection, which also uses a lightning bolt shape. So you can use these two Fibonacci techniques together, and you can see once price reversed here, we expect it to reverse off of the minus 61.8, which you can see it did. Okay. Okay, let me know if you guys have any questions. Okay, if not, I think we still have time to do a bit of live analysis. So you can let me know in the chat if there are any, oops, if there are any specific charts that you'd like me to go through. I think we might have time to just go through one. Okay, let's go through gold. Okay, can you guys see my charts? Okay, so on our weekly time frame, so like I mentioned earlier, we want to start off with our higher time frames and then work our way down to the lower time frames so that we get an idea of where prices are headed towards. So on our higher time frame, we can see this ascending, can definitely see price moving in this in an uptrend. Okay, so we're gonna see if we can find any ascending trend lines or trend channels to support that. Okay, I think I kind of can see, oh, can see this ascending trend channel. Okay, so what makes a valid trend channel is if there are at least two touches on top and two touches below. So let's look at our daily time frame now. Okay, and let's go in with some levels. Okay, so to start off, I think I have a Nike tick shape here. Okay, I'm gonna try and zoom in so that you guys can see. So the shape, the Nike tick shape is like this. Okay, and I can see that price is approaching my 161.8 level. So I'm gonna place a resistance level over there. This is my first resistance. My first support, I'm just gonna place it here at that swing high. Okay, so this is what we have on our daily time frame. So let's look at our 4-hour time frame now. Okay, on our 4-hour time frame, you can see we have this swing high. lining up nicely. And this is a resistance. Okay, I'm not sure if we have any Nike tick levels here since it's so small. Okay, no. If we take this Nike tick shape here as well, you can see the shape like this. Okay, can see the 161.8 lines up with our first resistance as well. Okay, and I'm just going to place our first support at this 127.2 level. Okay, next I'm going to be looking um, for some retracements. Also, this is my first support. And at this level, it's in line with this 38.2. Okay, so this is my second support level. Then I'll see if I can pull it back some more. Okay, so overall, we have a pretty bullish uptrend from our weekly as well as our daily timeframes. So we're expecting prices to continue to move upwards. So let's take a look at some indicators to support that. So I like to use Ichimoku and Mengi first because at one glance you can see exactly what the signals are. So price is moving above Ichimoku cloud, so it's giving us a bullish signal. Mengi is also giving us a bullish signal. If we look at Bollinger Bands, you can see it is also giving us a bullish signal. RSI. Actually, Bollinger Bands is not giving us a bullish signal. If I zoom in, it's not peaking above the upper band. So I'm gonna move this. If we look at our RSI, it is moving in the overbought area, which might be a signal that it's going to drop. So let's take a look at some other indicators. Let's look at stochastic. Okay, stochastic is moving in an ascending trend line, which could suggest that it's going to move higher as well. Okay, let's look at one more indicator. Okay, so MA cross recently occurred, okay, which suggests a change in trend. So over here, you see that price is kind of ranging in this area. Recently it crossed, which could suggest that it's going to move higher. Plus, prices are moving above both of the MAs, both of the moving averages. So it is still giving us a bullish signal. Okay, so I'm going to move my RSI because it doesn't support our analysis. Okay, so we're expecting it to continue to move higher towards our 161.8 and this swing high level here. Okay. Are there any questions? Okay, no worries. Okay, if there are no other questions or other requests, then I think that's all for today. Thank you so much for joining me, and I'll see you guys again next week. Thanks, everyone. What do you mean with toy? So basically, you click on this symbol, and let's say we are analyzing Euro USD, for example, right? And then, so depending on which broker you're looking at, click on it. And I like to start off with a clean chart. So it will look like this. Um, if that's what you need. Time frames are over here. Indicators here. If we're talking about Ichimoku, or rather Fibonacci, the Fibonacci is this one. This is the retracement. So like this. This is the projection I was talking about earlier, which has 3 points like this. Um, oh, so for your support and resistance levels, I just basically use this tab here, this moving tab, which has these horizontal rays. And when you click on it, it's actually blank, but they do give you the option over here on this icon to choose whether, what you want to label it as. For indicators, we have starred these, but you can look up. There are so many indicators out there, so depending on what you are comfortable with, for example, maybe pivot points, we didn't star. So if I'm looking at pivot points, I might star this as well, and then it will show up in my favorites here. But you can just search it here in the search bar. Sample resistance 1, we have them preset. Okay, for example, this. Um, do you mean the template? Oop. Mm, oh, for indicators, you set favorites, for example, pivot points with this star here. Yeah, add to favorites, and then it'll show up in this column here. For this template, I'm actually not too sure. Oh, like this. Save drawing template as, and then you type resistance 1, resistance 2, save, and then I think it will show up here. Okay. You have any other questions? Okay, we'll see if we can do a full session on how to use TradingView. But yeah, thank you so much for joining me. Thank you for the questions. Have a great rest of your week, and I'll see you again next week. Thanks. Bye.